Tesla took a nosedive along with the broader market this week, dropping another 3% on Friday on the back of red-hot inflation numbers. The company has already raised prices on its vehicles numerous times this year, but is in a strong position such that the demand for its cars is still off the charts and it can pass on the price increases to customers. Ridiculously high gasoline prices and even giant price increases for ICE vehicles as well continue to make electric vehicles a way to stop relying on the commodity that's affecting the price of not only fuel but also of any goods that need to be transported or that are made of oil as a raw input. Funny enough, Tesla shares closed the week at $69,669 per share, a meaningful number for Elon Musk, and the stock actually reversed course in after hours, with Tesla filing to do a 3-for-1 stock split that will be voted on by shareholders at the upcoming shareholder meeting in August. There's been talk of a potential stock split for some time now, and finally the company is moving forward with the decision. A 3-to-1 split will put the stock around the $200 range and still leaves room for more stock splits in the future, as compared with other options that Tesla had, such as doing a 10-to-1 split or greater. Typically, companies do a split after the stock has had a big move, but actually Tesla is announcing the split closer to the lows rather than the highs. While the stock split itself has no effect on the company, it certainly provides confidence to investors that the management team at Tesla believes the stock can go higher. Companies usually don't split their stock if they think it will go lower. According to Tesla, the stock split will allow employees to better manage and access the shares. The stock split will also allow small retail investors to buy a handful of shares, which could bring more interest into the stock that's been beaten down over the past few months. The reason for this is likely due to China lockdowns, as we'll soon see. But the media continues to blame Tesla's decline on the Twitter deal overhang. However, Elon's bid for Twitter has very little to do with Tesla's business. It doesn't at all affect how many cars Tesla sells. And this won't be a distraction for Elon Musk himself, who appears to be quite focused on Tesla, especially given his recent internal company emails we discussed in the last video, and he has a whole team of people helping him out. Elon Musk is quite good at multitasking, using about 3% of his time to help run the Boring Company and Neuralink, and investors don't seem to be penalizing Tesla stock for that. However, Elon does most of his Twitter stuff while on the toilet. If anything, he sold billions of Tesla shares already to help pay for the Twitter acquisition, and he sold when Tesla was over $1,000 per share. If the Twitter deal goes through for a lower price or falls through completely, he can technically buy back the Tesla shares under $700 per share right now, getting a 30+% discount on billions of dollars worth of stock, and that would be a positive for investors as well, since money could potentially flow back into Tesla. But in all, it doesn't make sense to look at Twitter in order to determine where Tesla is headed. And by the way, stop using Yahoo Finance, stop using Google Finance, and have a look at our website, themarketisopen.com, where we have instant stock quotes and financial data going back 10 years, and it's all freely available. Now, it was recently reported that Tesla registered over 139,000 of its electric vehicles between January and April of this year in the US, compared to the rest of the EV industry in the United States with roughly 44,000 vehicles. That's 76% market share that Tesla now holds in the US. Previously, Tesla produced 2/3 of all EVs sold in the country, but this has now increased to 3 of every 4 electric cars sold is now a Tesla. Tesla also still exports some of its vehicles. For instance, the Model S and X are only produced in the US but sold worldwide, so its production is actually higher than registrations, though it has replaced its European exports with exports from China instead, at least until Giga Berlin ramps up further and can take over. But in terms of Tesla's US market share, in order for them to maintain this massive share, they would need to keep growing US sales at the same pace as the industry. This is fairly difficult since Tesla would be coming off a larger base of 140,000 cars, while a company like Volkswagen, for instance, sold just 3,500 cars in the first 4 months of the year and can easily double that number or triple or even more, especially as they plan to bring their ID.4 into production in the US. Long term, Tesla is shooting for a 20% market share of the global auto market, so you would expect their market share to come down as the industry as a whole produces more EVs. But that said, Tesla has a few small tricks up its sleeve to try and keep its massive market share in the US for now, starting with Giga Texas is their small trick, which over the next few years could in fact help Tesla double or even triple its own US production. If the Fremont facility can make about 500,000 cars per year, Giga Texas is looking to add another million on top of that, which would roughly triple Tesla's footprint. In addition, however, Tesla is also looking to expand its Fremont manufacturing facility by over 50%, so the rest of the EV industry is still going to be facing some fierce competition to take US EV market share from Tesla. This seems more like a fun game for Tesla to dominate the other EV players. But the real losers, however, will be those automakers who are moving too slowly and switching their ICE sales to electric, and they'll be watching their market shares erode. Now, as a matter of fact, Elon Musk just recently congratulated the Fremont team for hitting a new all-time high in weekly vehicle production. At the same time, Giga Berlin almost hit 1,000 vehicles produced in a single week, which means that it will be contributing meaningfully to Tesla's delivery numbers. It's already at a 50,000 unit per year run rate, much higher than the production of most legacy automaker EV sales. And Elon Musk says that Austin is spooling up, possibly a reference to the 4680 batteries being created at the factory, which will likely still take time to ramp up this new technology in high volume despite good progress. Now, during the most recent Tesla conference call, Elon Musk said that Giga Shanghai was coming back with a vengeance. I highlighted this a few weeks ago, but in the comments some people were confused, like how could this be the case if the stock is down? First off, this is a bit backwards thinking, because the stock doesn't control where the company is headed, it's the other way around. The stock going down again has no effect on how many cars Tesla sold in China. While it's true that investors were worried about Shanghai because it was shut down for a month and will certainly affect the quarter, Elon Musk told us at the time that Shanghai was coming back with a vengeance. To me, that means it will come back stronger than ever before. He said they may pull a rabbit out of a hat there. And just recently he confirmed that the factory is indeed returning to full strength. So while we've seen reports that Tesla sold 33,000 cars in May and about 1,000 in April, if they're back to full power in June, it still means that about half of Shanghai's production will be missing from this quarter. It looks like up to 100,000 cars could have been produced which weren't due to factory shutdowns in China. Not to mention that the rest of the supply chain also relies on parts from China, and European deliveries also happen to depend on the China factory. So Q2 is expected to be weak, though may potentially get some help from small increases at the other three factories. Nevertheless, this leaves Tesla open for a stellar back half of the year, with all four factories contributing meaningfully to production and sales. And finally, along with Tesla's stock split announcement, Oracle founder Larry Ellison will be stepping down as a Tesla board member. Now, Ellison originally joined Tesla's board at the end of 2018, at a time when some people, largely the media, were calling for stronger oversight at Tesla, and the stock was seeing high volatility due to events such as the going private tweet. Larry Ellison was meant to help bring stability to Tesla, along with vast expertise and technical knowledge of leading and building a large tech company from a startup. Ellison was an independent board member and also a trusted friend of Elon Musk's and a strong believer in Tesla, owning 3 million shares at the time. Today, that's equivalent to 15 million shares post-split, with Ellison owning 1.5% of the company. By comparison, Elon Musk owns 23.5% of Tesla. However, it seems that over the last few years, Larry Ellison has indeed served his purpose on the board of Tesla, and so this event, which could easily be spun out to be negative, that the board is losing Ellison's wealth of expertise and know-how, may instead be positive that Tesla has in a sense graduated from its wilder 2018 days and has become more independent, drawing in more sensitive investors who are now more comfortable with owning the company. So do you think that Tesla has grown as a company since 2018 when Larry Ellison originally joined the board? And do you think Tesla's expansions in vehicle growth in the United States will allow them to maintain their 76% market share even as the industry is coming off a small base? Please hit the like button and subscribe. We would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.